Imagine having the secret to transform your financial life by investing in a simple and accessible way. Peter Lynch, one of the most influential managers in history, believed that anyone with curiosity and dedication could succeed in the financial market. He proved that the extraordinary is within everyone's reach simply by observing and investing in what we truly know. Contrary to the complex myths surrounding investment, Lynch demonstrated that true financial intelligence arises from autonomy and observation. Today, we will explore the invaluable lessons he left behind and discover how to apply them to achieve incredible and lasting returns. Introduction to Peter Lynch's investment philosophy. Peter Lynch always believed that the extraordinary in investments was not found in complex calculations, but in the curiosity and intelligent observation of the world around us. He stated that anyone, if they knew where to look, could find high-potential companies before market analysts did. His strategy was simple. Look at everyday life, the brands, products, and trends that were already on the radar of ordinary people. Lynch understood that those who closely observe what they consume and investigate the market around them have a better chance of discovering promising opportunities. Thus, he encouraged investors to focus on what they knew rather than trying to decipher sectors they didn't understand. One of his most influential lessons was about the advantage of individual investors over professionals. While many managers were bogged down by complex data and forecasts, he noted that ordinary people could anticipate good opportunities simply by paying attention to daily life. When you see a store that is always busy, a product that is sold out, or a brand that is gaining popularity, there is already a clue to what might become a good investment. This highlights the importance of being attentive observers and always being open to the possibilities around us. He used well-known brands of stores and popular products as examples that, in his view, were more than just fleeting trends. They were indicators of growth. Companies like Dunkin' Donuts and Taco Bell, brands he saw expanding rapidly, became some of the smartest investments of his career. This ability to see potential in the companies around him was a combination of curiosity and the willingness to act without hesitating over what others might consider too simple to be valuable. Another interesting aspect of Lynch's philosophy was his approach to risk. For him, the risk was more in investing in what he didn't understand than in the natural fluctuations of the market. Therefore, he sought deep knowledge of the companies he invested in, understanding the products, the audience, and the growth possibilities. This level of involvement transformed the simple into something sophisticated, allowing him to make safer and more informed choices. It is a lesson in how knowledge and familiarity can reduce uncertainty in any investment decision. With Lynch, the concept of investing in what you know was not a rigid rule, but rather a piece of advice not to underestimate what is around us. Often, people seek complex businesses thinking they will yield greater returns, but he showed us that it is possible to build a profitable portfolio with common and even familiar companies. Lynch knew that financial intelligence lies in valuing what we know, and this earned him one of the most historic returns of all time. In addition to observing daily life, Lynch also recommended thoroughly studying reports and understanding each company's history. He believed that companies' annual reports were a hidden treasure for anyone wanting to truly understand the business. In this way, his investments were guided by both observation and in-depth research, balancing intuition with technical knowledge. This innovative posture showed the world that success does not require extreme complexity, but rather discipline and detailed investigation. Finally, Lynch believed that investing is something that any ordinary person can do well if they have the curiosity to observe what works and the courage to trust their own perceptions. He argued that if each investor learned to look for opportunities as he did, they could achieve significant returns. With this, Peter Lynch created a simple yet extremely effective investment philosophy, inspiring people even today to turn their observations into intelligent financial decisions. The concept of 10-bagger and the growth potential of stocks. One of Peter Lynch's most extraordinary and innovative concepts was that of the 10-bagger, a term he coined to refer to stocks that multiply their value by 10 times or more. This term, which comes from baseball, where 10 bags indicates a high score, summarizes a philosophy of seeking growth stocks with exceptional return potential. Lynch believed that any investor with a sharp eye and a good dose of curiosity could find a 10-bagger around them. It was like searching for the next big name in the industry, the company that was at the beginning of an extraordinary expansion. He saw these stocks as a rare chance for returns that could transform any investor's portfolio. For Lynch, the key was identifying promising businesses at the right moment. Many of the 10-baggers in his career were companies that started small but had an expanding market and solid products. Examples include retail chains, restaurants, or even clothing brands that, with a well-executed strategy, managed to capture the public and increase their sales year after year. The incredible thing is that, according to him, these opportunities are not always found in giant companies, but in smaller companies that still have a great growth path ahead. This brings an essential lesson. Do not underestimate small businesses. Often, that is where the most influential potential lies. In addition to size, Lynch also saw potential in companies that dominated specific and innovative niches. He stated that a company with a unique product or service could grow much faster than large corporations that had already reached their ceiling. This thinking led him to invest in innovative companies that were changing the market in areas such as technology, food, or healthcare. Even when many investors looked skeptically at these smaller companies, he saw a historic opportunity in them. For Lynch, innovation did not have to be complex. It could come from the simplicity of a well-executed idea capable of winning over consumers. Lynch also emphasized that a 10-bagger is not always easy to identify. This type of stock requires patience and a keen eye for long-term potential, even when short-term prospects do not seem promising. The temptation to sell a stock right after a small gain can be strong, but he always emphasized the importance of holding on to those promising investments to allow them to grow. In this sense, his investment strategy went beyond financial analysis. It was a philosophy of patience and conviction. He was not in a hurry because he knew that the greatest rewards take time and persistence. Another point Lynch highlighted was the importance of not being swayed by pessimistic opinions. He often mentioned that it is common to hear criticism and skepticism about stocks with rapid growth. However, he saw these criticisms as an opportunity to observe what really mattered: the company's performance and consumer acceptance. He knew that if a company continued to grow and win over its audience, critics would eventually be silenced by the results. With this, Lynch teaches us that it is essential to filter information and trust our own analysis. Finally, Lynch emphasized that finding a 10-bagger was not just a matter of luck, but rather a preparation and continuous research. He always encouraged investors to read reports and understand in depth the companies they invested in. For him, curiosity and the effort of research were the most powerful tools for identifying companies with extraordinary growth potential. This inspiring vision shows us that success in investing depends more on the determination to learn than on luck. The advantage of the individual investor, according to Peter Lynch. Peter Lynch firmly believed that individual investors had a natural advantage over professionals in the financial market, an idea that still sounds innovative and intriguing today. For him, this advantage stemmed from the fact that the average investor is closer to changes in consumer behavior. While managers and analysts are stuck in spreadsheets and forecasts, the individual investor lives everyday reality. They see popular stores always full, hear word-of-mouth news, and perceive trends long before they are reflected in financial reports. According to Lynch, this direct connection to the market allows any curious and attentive person to identify incredible opportunities, often before large investment funds do. Lynch always argued that individual investors should trust what they know. He believed that by observing the companies that are part of their own lives, like the supermarket where they shop, their favorite clothing brand, or the most frequented restaurant in town, investors could gain valuable insights into the future of those businesses. This perspective may seem simple, but it is precisely what makes Lynch's method so intelligent and accessible. It is not necessary to have an advanced finance degree to identify trends in daily life. One just needs to observe closely what people are consuming and how this changes over time. This direct contact with the market is something that professionals, no matter how technical they are, often cannot replicate. Lynch's vision also included a practical recommendation for individual investors: research before buying a stock. It is not just about seeing a famous brand and impulsively buying its shares, but understanding the history, goals, and growth potential of the company. He encouraged investors to read annual reports and investigate the company's finances like a market detective. He knew that individual investors do not need complex analyses. They need straightforward analyses that make sense in their context. Thus, the advantage of the individual investor is not just knowing the brand, but being able to dig deeper. Another point Lynch emphasized was that individual investors are not bound by the same deadlines and return targets that professionals face. Fund managers must deliver results on a shorter timetable, as they are accountable to shareholders and clients. On the other hand, individual investors have the freedom to build a long-term view and monitor a company's growth without haste. This lack of pressure is a significant advantage, as it allows the investor to hold on to their stocks and reap the rewards of appreciation over time, just as Lynch did with his 10 baggers. This gives the ordinary investor a distinct position in the market. They can truly think in years, not months. The authenticity of the individual investor is also another trump card, according to Lynch. Since they are not tied to market trends or the expectations of others, they can invest in companies they genuinely understand and believe have potential. This kind of choice is a luxury that many fund managers do not have, as they often end up following what the market demands. Lynch knew that investing in something one understands deeply generates more confidence and avoids impulsive decisions during crises. Thus, he encouraged every investor to value their own experience and develop an independent view based on solid knowledge. Lynch also taught that the average investor should learn from their own mistakes and adjust their strategy over time. He saw no problem in making mistakes, as long as each mistake was a lesson for the next investment. With this, Lynch encouraged a growth mindset. He believed that individual investors could build their own skill set, becoming increasingly stronger if they were willing to learn. This attitude is what allows ordinary people to achieve extraordinary returns and become more influential in their own success. Finally, Lynch conveyed a motivating message: that individual investors do not need to have all the resources of the financial market to achieve significant results. With an attentive eye, a curious stance, and a commitment to understanding the companies they invest in, anyone can succeed. He saw the individual investor as someone with potential, as he believed that intelligence in investing does not come from complex formulas, but from an independent mindset and constant observation. And with this, Lynch proved that the market can be fertile ground for those willing to see beyond the obvious. The importance of knowing sectors and companies. Peter Lynch always highlighted the importance of not only knowing the companies in which one invests, but also the sectors in which they operate. He believed that each sector has unique dynamics, challenges, and opportunities, and that understanding these aspects can make all the difference when choosing a stock. Lynch knew that certain sectors, such as technology or healthcare, have extraordinary growth potential but also carry their own risks. For him, the investor should familiarize themselves with the characteristics of each area to identify what could be innovative and what could become a long-term problem. This type of analysis allows for a more strategic outlook, preventing the investor from betting on unknown sectors and minimizing the risks involved. An interesting example is how Lynch evaluated sectors with cyclical trends, such as automobiles and construction. He observed that, in these cases, growth can be temporary and dependent on favorable economic conditions, which means that a company may seem promising at a given moment, but suffer abrupt declines with changes in the economic landscape. Lynch was cautious with these cycles and recommended that investors thoroughly understand them before investing. This stance reinforces that, to invest intelligently, it is necessary to know the highs and lows of the sector and choose companies that can withstand these fluctuations. Lynch also emphasized the importance of analyzing companies that stand out in what he called boring markets. He noticed that sectors that did not attract much interest, such as sanitation or packaging, often had some of the best opportunities for lasting investments. These companies, being in stable and unglamorous sectors, typically exhibited lower volatility and tended to grow consistently. By valuing the potential of neglected markets, Lynch demonstrated that the financial market is not just about the most popular trends, but about identifying value where few look. Another essential point that Lynch advocated was the need to know the products and services a company offers within its sector. He believed that investors should understand what makes the company's product unique, who its consumers are, and what differentiates it. This in-depth analysis helps to identify what really matters for long-term success. If a company launches a product that addresses a specific need and positions itself as a leader in innovation, this can be a sign that it is ready for extraordinary growth. Lynch knew that the product is the soul of the company, and without a detailed analysis of it, any investment could become a shot in the dark. Lynch also pointed out the importance of observing the competition within the sector. He suggested that investors keep an eye on competing companies to understand how each one positions itself and differentiates itself. This view allows for evaluating whether the chosen company has a real competitive advantage or if it runs the risk of being overtaken by others. For example, if a company dominates the local market but faces competition from multinationals that can offer lower prices, this is a warning that it may not have much long-term stability. This type of analysis is essential for investing more securely, identifying companies that can truly thrive in a competitive sector. Furthermore, Lynch advocated that investors seek companies with the flexibility to adapt to changes in the sector. He knew that the market is in constant transformation and that rigid companies tend to lose competitiveness over time. Companies that can reinvent themselves and keep up with new demands in the sector are more likely to become influential in the long term. Therefore, when investing, it is important to check whether the company has a leadership team and a culture that encourage innovation and constant adaptation. Finally, Lynch believed that knowing the sectors and companies enables us to make safer and more informed investment choices. He taught that this type of analysis does not need to be extremely technical, but should be directed toward understanding the basics, how the market works, what the risks are, and why that company stands out. With this, he showed us that investing is not just a matter of luck or timing, but of analysis that combines curiosity with practical understanding of the market. And it is this vision of Lynch that continues to inspire investors to study sectors deeply before making their choices. How to identify a good company to invest in according to Lynch. For Peter Lynch, the ability to identify a good company to invest in starts with genuine curiosity and an attentive eye on what happens around us. He believed that a promising company exhibits characteristics of sustainable growth and has a clear success story. Lynch recommended looking for companies with a competitive advantage, meaning something unique that sets them apart in the market. This can be an innovative product, a strong brand, or even an extremely loyal customer base. For him, these signs indicate that the company has incredible potential for growth and consolidation. He observed that many successful companies started small and with a well-defined niche that gradually expanded. One of Lynch's practical tips for identifying good companies is to look at earnings. He sought those with a history of profit growth and the potential to maintain that performance over the long term. However, it is not enough for profits to be growing. Lynch also examined the consistency of that growth. For him, a company that grows gradually, even if slowly, is more reliable than one that exhibits spikes in growth followed by sharp declines. According to Lynch, consistent growth, even if modest, indicates that the company has control and maturity to manage its operations, a positive sign for long-term investors. Additionally, Lynch placed great importance on analyzing the fundamentals of the company. He recommended that investors look at simple indicators, such as the price-to-earnings (PE) ratio, to see if the stock is expensive or cheap relative to its earnings. For him, a company with a low PE and good growth prospects was an excellent investment opportunity. Lynch emphasized, however, that these indicators should be analyzed carefully, always considering the sector and market in which the company operates. This way, he teaches us that investors should not cling to a single number, but rather analyze the context in which the company is inserted. An essential point for Lynch was the level of the company's debt. He warned that highly indebted companies represent a risk, especially during economic crises. For him, the ideal is for the company to maintain financial balance, with debt that does not compromise its growth capacity. Lynch believed that companies with low levels of debt have more flexibility to invest in innovation and expand their operations, which is an excellent sign for anyone looking for a solid investment. He reminds us that a financially healthy company is an important step toward ensuring consistent returns. Lynch also encouraged investors to pay attention to the company's management, evaluating the competence and track record of its leaders. He believed that good management makes all the difference in a company's success, and that leaders focused on sustainable growth tend to make safer and smarter decisions. For this reason, Lynch often studied the profiles of managers and their trajectories, observing whether they had the ability to inspire their teams and implement good governance practices. Companies with visionary leaders committed to innovation stand out, as they have a solid foundation to face challenges and explore new opportunities. Another important aspect that Lynch observed was the impact of the company on people's daily lives. He suggested that investors analyze how the company's product or service is perceived by the public and whether there is a growing demand. For him, a good investment is one that solves real problems or makes people's lives easier, ensuring natural market acceptance. If a company can create products that consumers genuinely value, the chances of growth are much greater. This is an indicator that any investor can observe, especially those who follow the philosophy of investing in what they know. In summary, Lynch teaches us that identifying a good company is a combination of curiosity, research, and common sense. He did not believe in magical formulas, but in intelligent analysis that considers the potential of the company and the context in which it operates. For Lynch, the secret was in seeing the extraordinary in the ordinary and investing in companies with solid growth potential and constant innovation. This vision continues to inspire investors to find opportunities in the details and make informed decisions, building a solid and promising investment portfolio. Patience and timing in investment according to Lynch. For Peter Lynch, timing, that is, the right moment to invest, is an art that requires patience and a good dose of observation. He argued that a successful investor is one who can wait for the right moment to enter and exit a stock. But, contrary to what many think, this does not mean trying to predict market movements at every instant. Lynch believed that investing is more about understanding the value and potential of a company than about trying to anticipate short-term fluctuations. This uncomplicated view of the market differentiated him from many other managers and allowed him to achieve incredible results over the years. For him, the secret was in identifying promising stocks and giving them the necessary time to appreciate. One of Lynch's most curious teachings is about the importance of maintaining a long-term view. He explained that many stocks present extraordinary potential, but it takes time for that potential to materialize. Lynch saw investment as a marathon, not a sprint. In his philosophy, the investor who knows how to wait, who has the patience to follow a company's growth over the years, is rewarded with returns that impatient investors miss out on. Therefore, he always encouraged patience, as it is what allows the investor to capture the most robust gains. Another essential point that Lynch emphasized was not to be swayed by momentary drops. He observed that, in volatile markets, stock prices can often fall without a fundamental reason. In these moments, Lynch advocated that investors should not panic but analyze the reasons for the drop. If nothing has changed in the company's fundamentals, the decline may just be a natural market fluctuation. For him, downturns are even opportunities to buy more shares at attractive prices, as long as the investor has confidence in the company's potential. This advice from Lynch is invaluable, as it teaches how to maintain calm and confidence in one's own analysis, even amidst volatility. Moreover, Lynch taught that the right time to sell a stock is not when it reaches a temporary peak, but rather when it ceases to have the growth potential it initially promised. He believed that when investing, the focus should be on the quality of the company and the growth it can still provide. Therefore, He recommended that investors monitor the company's performance, but not rush to sell for a quick profit. Lynch understood that a stock could continue growing for years, and that the investor should be willing to follow it until its appreciation cycle is genuinely complete. For Lynch, patience was also important when waiting for investment returns. He understood that some companies need time to mature and consolidate their business models. This means that investors must have realistic expectations about how long it will take to see results. Lynch viewed investments as an organic process, where each company has its own growth rhythm. Thus, the investor who demonstrates patience and respects the necessary time for a company's development is rewarded with solid and consistent returns. Another teaching of Lynch about timing is that investors need to accept that not all choices will be successful. He knew that the market is unpredictable and that some companies do not achieve the expected growth, even if they initially seem promising. For him, this is part of the process and should be faced with naturalness. The idea is that by maintaining a diversified portfolio focused on good companies, investors can offset occasional losses with significant gains from stocks that genuinely appreciate. It is an intelligent approach that protects investors from greater losses and allows for sustainable growth over time. Finally, Lynch teaches us that patience in investment is a form of emotional intelligence. It is the ability to maintain focus and calm in the face of market fluctuations, believing in the potential of one's analysis and the growth of the chosen companies. This approach, combined with the understanding that time is an ally in investing, makes Lynch a reference for those looking to build solid wealth. He showed that the ideal timing comes from patience and conviction, two qualities that any investor can develop and apply to achieve consistent returns. The value of simplicity in investments. Peter Lynch always defended that simplicity is one of the greatest virtues for investors. He believed that the financial market does not need to be complex and that investors do not have to get lost in advanced formulas to succeed. Instead, Lynch taught that the essential thing is to understand the basics, knowing what the company does, how it makes money, and why its business has potential. For him, a good investment is one that any ordinary person can explain in a few words. Simplicity, therefore, is more than a preference. It is a strategy to identify opportunities clearly and directly without unnecessary complications. Lynch used popular brands as examples to illustrate how simplicity can be a powerful ally. He showed that by observing companies everyone knows and that offer widely accepted products or services, investors can already gain a basic understanding of the company's potential. This type of analysis may seem superficial, but for Lynch, it is a starting point for identifying businesses that truly make sense. Rather than complicating things, he simplified them, and this attitude allowed him to find some of the most profitable opportunities of his career. He believed that by keeping the analysis simple, investors reduce the risk of confusion and poor decisions. Moreover, Lynch argued that simplicity allows for more objective decision-making. He knew that the more complex the analysis, the easier it is to get lost in details and deviate from the focus. For this reason, he encouraged investors to be objective and to concentrate on the essential aspects of the company. If a stock requires complicated explanations to make sense, Lynch suggested that it might not be a good choice. This practical and straightforward approach is one of the greatest legacies he left behind, showing that a clear and simplified perspective is one of the best guides in the world of investments. Another interesting point is that Lynch saw simplicity as a way to protect against fear and doubt. He knew that the financial market can be volatile and unpredictable, but when the investor knows the companies they have chosen well and understands the basics of their business, it is easier to maintain confidence, even in difficult times. This clarity allows the investor to hold on to their stocks without making impulsive decisions because they know exactly the value and potential of each company. For Lynch, this is one of the greatest advantages of simple investing, the ability to remain calm and focused in any scenario. Lynch also believed that simplicity helps to avoid common mistakes, such as investing in companies that one does not understand or that are outside their area of knowledge. He warned that by trying to impress with complex choices, many investors end up losing their way and taking unnecessary risks. For him, It is preferable to invest in familiar sectors and in companies whose business the investor comprehends, as this allows for a more secure and grounded analysis. He reinforced that in the end, investing is about making informed decisions, and simplicity is the safest path to achieving that. In his philosophy, Lynch argued that simplicity also facilitates monitoring investments. He knew that investors' lives are full of information and decisions, and that a simple stock portfolio allows for more direct and practical oversight. When investors choose companies and sectors they understand, they do not need to spend hours analyzing complex reports to know if the investment is performing well. Lynch believed that an investor's time is precious and should be spent wisely, making simplicity an even more strategic choice. Ultimately, Peter Lynch saw simplicity as a tool of intelligence and self-confidence in the market. He proved that success in investments does not lie in complications or mysteries, but in clear decisions based on simple and objective observations. With this, he taught that any investor can achieve great results, as long as they have the courage to keep things simple. This lesson remains one of his most influential teachings, showing that the extraordinary in investments lies in the ability to see value in simplicity. The role of diversification in investment. Peter Lynch always emphasized the essential role of diversification in a smart investment strategy. He believed that diversifying a portfolio is a form of protection against market unpredictability, ensuring that the investor is prepared to deal with fluctuations and unexpected variations. For Lynch, diversification did not mean buying a large number of stocks indiscriminately, but rather building a balanced portfolio with companies from different sectors and risk profiles. This allowed investors to protect themselves against significant losses, especially when a specific stock did not meet expectations. With a diversified approach, Lynch shows us that it is possible to navigate market uncertainties with greater security. One of Lynch's main guidelines on diversification is the importance of choosing companies that are at different stages of growth. He suggested that investors combine shares of well-established companies, which provide stability, with shares of emerging companies that offer greater growth potential. This balance allows investors to have a solid base to support their portfolio, while also exposing themselves to faster appreciation opportunities. Lynch knew that mature companies tend to be more resilient in crises, while growing companies can take advantage of expansion periods to generate extraordinary returns. Lynch also believed that diversification should be done with care and criteria. He warned that investors should avoid excessive diversification, which can dilute returns and make it difficult to monitor each investment. For him, a well-diversified portfolio does not need to have dozens of stocks. It just needs to be composed of solid companies with potential across various sectors. Lynch advocated that investors closely monitor the stocks they own, and for this reason, having too many assets can become counterproductive. This balance between diversification and focus allows for efficient management and provides security without complications. Another point Lynch highlighted about diversification is that it can protect investors from specific crises in market sectors. He knew that each sector has its own cycles, and that economic problems can affect certain areas more severely than others. By diversifying across different sectors, investors avoid the risk of a sharp decline in one area harming the entire portfolio. This underscores the importance of including stocks from varied sectors, such as technology, healthcare, consumer goods, and industry, in the investment strategy. Lynch viewed diversification as a shield, a way to maintain portfolio stability even when the market faces turbulence. Lynch also encouraged international diversification, believing that investing in companies from other countries can offer significant opportunities and an extra level of protection. He knew that the economic and political performance of different regions varies, and that a globally diversified portfolio helps reduce exposure to the risks of a single country. By investing in foreign companies, investors benefit from economic trends that may be rising in other parts of the world, increasing their return potential. Lynch saw this as an intelligent way to take advantage of global opportunities while protecting oneself from local market fluctuations. Another interesting aspect is that Lynch viewed diversification as a way to explore extraordinary opportunities in less obvious niches. He knew that significant gains often come from smaller and lesser-known companies that have high growth potential. Diversifying a portfolio to include stocks from these innovative niches allows investors to participate in emerging trends and underexplored sectors. For Lynch, curiosity and the willingness to diversify into new and unpopular areas were fundamental qualities of a successful investor. In summary, Lynch saw diversification as a strategy that balances security and growth potential. He demonstrated that a diversified portfolio is one of the pillars of good investment management, allowing investors to seize opportunities consciously and in a controlled manner. With thoughtful diversification, Lynch taught that it is possible to grow in the market without exposing oneself to excessive risks. His legacy is a lesson in intelligence and prudence that continues to inspire investors today to develop a solid and effective diversification strategy. Learning from mistakes and the importance of flexibility. Peter Lynch viewed mistakes as a natural and necessary part of the learning process in investing. He knew that in such a complex and unpredictable market, even the most experienced investors make mistakes. Instead of fearing these errors, Lynch taught that what matters is to draw valuable lessons from each of them. He believed that when investors admit and analyze their mistakes, they can develop a resilient mindset and learn to avoid the same traps in the future. For Lynch, this approach allows investors to evolve, strengthening their critical thinking and their ability to make smarter, more informed decisions. One of Lynch's most curious lessons is that a mistake can be the best teacher, as it exposes where the investor still has blind spots or impulsive tendencies. He said that understanding a mistake offers a deep learning experience that no financial theory can teach. This includes understanding why a stock was bought, how reasoning was influenced, and what was neglected in the analysis. Thus, Lynch encouraged investors to always revisit their decisions, questioning whether they truly understand each choice. This habit allows investors to become increasingly aware of their own behavior, developing a more critical and refined perspective. Lynch also taught that flexibility is essential in the world of investments. He explained that the market is always changing and that companies face new challenges and opportunities constantly. For Lynch, an investor who remains rigid in their convictions ends up missing opportunities or exposing themselves to unnecessary risks. Flexibility, on the other hand, allows investors to adapt to changes and seize opportunities that arise without clinging to fixed or outdated ideas. He argued that investors should be willing to change their strategy whenever the situation demands, maintaining an open and receptive mindset. An interesting point that Lynch highlighted was the importance of not clinging to a stock simply out of pride. He knew that the confirmation bias leads many investors to hold on to stocks that no longer have the initial potential, just to prove that their choice was right. Lynch warned that the market is not personal and that investors should not mix their emotions with financial decisions. Knowing when a company has ceased to be a good choice is a valuable skill that requires humility and a practical outlook. With this, he reinforced the importance of setting aside pride and being objective in every decision. Lynch also argued that flexibility is crucial for exploring new opportunities that may have seemed less obvious before. He knew that over time, investors can gain knowledge and confidence to explore different sectors and companies from the ones they initially considered. Thus, he encouraged each investor to evolve their strategy, always seeking a balance between what they already know and what they can learn anew. Lynch viewed curiosity as a fundamental ally of financial success, as it allowed investors to broaden their horizons and have the courage to try new ideas, intelligently diversifying their portfolios. For Lynch, recognizing and correcting a mistake was as important as identifying a good opportunity. He taught that success in investing is not about being right all the time, but about minimizing damage when mistakes are made and maximizing gains when one is right. This practical approach allowed Lynch to see the market more realistically and balanced, without idealizations. He shows us that the ability to adapt and learn from mistakes is what distinguishes amateur investors from the more experienced ones. Finally, Lynch leaves us with a powerful lesson about how a flexible and open attitude toward constant learning can be an investor's greatest asset. He demonstrated that achieving extraordinary results requires a willingness to rethink one's strategies and learn from failures. At the same time, Lynch reminds us that success in the market is a journey of continuous learning, where humility and adaptability are as important as any technical knowledge. With this, he inspires investors to cultivate a growth mindset, learning to reinvent themselves with each new challenge. The philosophy of do your own research and the importance of autonomy. One of Peter Lynch's most influential principles was his emphasis on doing your own research before investing. He believed that every investor should be responsible for their choices, and that to achieve success, it is essential to have a genuine and independent understanding of the companies they invest in. Lynch knew that it is easy to get swayed by the opinions of experts or market rumors, but he believed that direct and in-depth knowledge is what truly differentiates a secure and successful investor. This principle of autonomy is one of the most powerful lessons Lynch left us, as it encourages investors to delve deeper rather than simply following the crowd. For Lynch, doing your own research involves analyzing not only the finances, but also the market and the strategy of each company. He suggested that investors investigate reports, read about the sector, and observe the company with a critical and attentive eye. This process may seem laborious, but Lynch argued that it is precisely this effort that provides clarity and confidence in decisions. By conducting their analysis, investors build a solid view based on data and personal observations without relying on external forecasts. Thus, he teaches us that knowledge is the most valuable asset, and every investor should be willing to invest time in their own preparation. Lynch also warned about the dangers of blindly following analyst advice or relying solely on popular trends. He believed that many investors harm themselves by buying stocks that are rising just because everyone is buying. This posture, in addition to being risky, takes control away from the investor, who ends up depending on external influences. Lynch reminds us that the financial market can be volatile, and that trusting only in common sense is a dangerous strategy. With his philosophy, he encouraged each investor to develop autonomous thinking based on concrete data and to maintain an independent stance amid market fluctuations. Another important point that Lynch always reinforced was the importance of tailoring research to one's profile and financial goals. He knew that each investor has a unique reality, with different time frames and risk tolerances. Lynch recommended that each person investigate companies aligned with their profile, rather than trying to replicate the strategies of large investors or following stocks they do not understand well. This personalized approach allows investors to feel more comfortable and confident, as their decisions reflect their own knowledge and a suitable analysis for their reality. This highlights the value of investing in something that makes individual sense. Lynch also recommended that investors track their stocks over time and adjust their analysis as new data emerges. He knew that an initial research effort, no matter how solid, needs to be constantly revisited, as the market is always changing. By monitoring the company's performance and the sector's conditions, investors can make more informed decisions and adjust their strategy when necessary. For Lynch, the market is a living organism, and an investor who observes, analyzes, and adapts maintains control over their investments, regardless of trends. Finally, Lynch believed that autonomy in research leads to greater satisfaction and personal fulfillment. He knew that one of the greatest pleasures in investing is seeing one's own decisions pay off and knowing that profits came from an analysis made by the investor themselves. This sense of achievement and independence is unique, and Lynch saw it as a way to enrich not only financially, but also in self-confidence. With his philosophy, he encouraged investors to trust their own abilities and to build a robust and lasting financial knowledge. In the end, Lynch leaves us a valuable lesson that knowledge and autonomy are the keys to success in the financial market. His do-your-own-research philosophy inspires investors today, showing that by developing their analysis, anyone can make safe and well-informed decisions. Lynch teaches us that financial success is accessible to all who are willing to learn and invest time in their own education, building a solid foundation to achieve extraordinary returns and an independent investment trajectory. With Peter Lynch's lessons, It has become clear that success in the financial market is within reach of anyone willing to learn and observe. And you, are you ready to apply this knowledge and transform your finances? Take advantage of what you've learned and take the first step towards a more prosperous financial life. Subscribe to the channel and turn on notifications to continue learning about the world of investments and not miss any opportunity